The recession, I mean, I think it's going to be equally unkind to those people that have ESG and people that don't have ESG. It's like a tornado. It's not going to say, I'm going to avoid you and hit you. I think it's going to come through, and it's going to come through hard, and it's really going to be a question of who's going to be able to weather the storm. Because I think this time, unlike last time, because the most expensive words in the English language are, it's different this time, right? But I will say one thing that is different this time is the ability to cut interest rates. So I clearly remember 2007 and all the investment banker presentations where there was this wall of worry where they showed all the debt that was coming due in the next 7 years, and it was a mountain, and they'd say, the markets can't possibly absorb this, but we didn't think about being able to cut interest rates down to the level that we have. So I'm not sure what we have in our quiver now this time, or the recession to come through. So I think leverage is going to be a big thing.
Talking about the recession impact, agree that it's going to be equally harsh on both. But one of the things that limited partners are expecting is that if we do go into a recession, capital will be a little bit harder to come by. And as limited partners, we may have a greater say in and more power with the GP in terms of what we want. So today, a lot of our members, let's say they want 10 things, and 2 of those things are ESG related, but they know that there's 10 LPs behind them who won't ask for anything just to get into that fund because the returns are so good. As returns start to become less favorable, LPs will have more power. They'll be able to ask for more and get it. So a little nuance on what Donna said.
On the crisis thing, I'm very disappointed to hear that the tornado is going to hit my portfolio too. But I agree with you there. We're preparing with every one of our portfolio companies to what the different downturns can be, and on all different stakeholders. But I think we're not that different than any other than in my old job in the more traditional fund.
To the question about ESG and what its impact has been on company performance, it's very interesting because I think that when you think about company performance, people tend to look at stock price, and stock prices are very noisy, and it's very, very difficult, I think, to come up with something where we could, come up with an equation where we would separate out everything but ESG. I mean, we see this in the corporate governance area too, where people have been trying to think about, is there a premium for corporate governance? How can we come up with an equation or something that captures everything and says, okay, of the stock price, this much is due to good governance. I think that's pretty difficult.
On public markets, I'm not an expert. My personal view, and this is definitely, I don't know if this is a Bain Capital view, should ask our CEO, but is that I have not seen the data yet proving that there is a positive, and I totally agree with the bias of share price and versus actual financial real economy versus market economy. But I have not seen the data showing something that proves passes the causation versus correlation tests on the positive performance. I have seen recently a great paper from Morgan Stanley, which I thought was interesting, which showed that where it didn't maybe help on the upside, it helped on the risk mitigation side. And so there was on sustainable company portfolios, there was less downside. There were less extreme negatives than on average. And so that's food for thought. I think, we talk about ESG materiality and risk mitigation. I thought that was interesting data, if you want to look that up.
And then to the question over here about companies like Patagonia, I think to the extent, and I agree with Emily, that limited partners are not able to pound their fist and create change right away, but to the extent that change does happen, whether it's incremental, how quickly it happens, you may find some companies trading at some level of a premium, right, in the marketplace that have good practices. But that's going to take a little bit of time. But I could see that. I could see people saying, you know what? This deal also has the attractiveness to us of being a high-quality company, well perceived by consumers, highly rated on whatever metrics we want to call as ESG. and then that works its way into the stock price. And maybe there's a whole opportunity for private equity to say, you know what, this company that I'm buying doesn't have that premium, and I can get it up there on that scale, and that becomes a component of value creation. You know what I mean? But I think that that's just like, instead of like cost cutting is a component of value creation, our ability to create value around ESG becomes a component of value creation.
In terms of the Patagonia question, and are there going to be more and more companies like Patagonia who are quote-unquote impact companies, and more interest in private equity to invest in these companies? I think it's already happening, and Chris and I were just chatting a little bit before we sat down, and impact investing is like the new black, and it's very trendy. And even though you feel like you're a newer fund and a newer effort, you were somewhat on the forefront, and you've been doing this and thinking about it longer than some of the firms that are now calling.
4 years.
Yeah, but seriously,
No,
but
it's
within the last year,
Yeah.
Think about all the funds who are calling themselves impact funds, and it's not necessarily to the point about it being a little bit fuzzy as to what an impact fund is, but everybody wants to measure impact now. It's very much the norm, and there are consulting companies, and that's what they do. They go around and tell you how do you take your fund that was not meant to be an impact fund and start to measure impact across your portfolio. So I would say expect to see a lot more discussion about impact, even if it's not initially the founding principle of the fund.
On your question, I mean, that's my bread and butter, and I personally made the shift to this industry because I believe this is the trend, and what I would say is we're seeing an increasing shift in B2C companies, consumer facing, where you get paid for impacts more. Because us as consumers, if I did a show of hands, who would pay more for a more, cleaner supply chain or a cleaner global supply chain, or better for you product, or et cetera, most of us would, especially in the more privileged room, the setting that we are. And so when you're looking at kind of every single subsector in the industry, in the consumer worlds, you get impact alpha, which I'll call you get a premium for doing the right thing. And so we're seeing that domino effect being faster. I would like that. I actually think the impact of a lot of consumer companies can be very material, but not necessarily as great as other impacts as a healthcare company, a manufacturing company, an education company. And I would like all those B2B companies and less kind of front-facing B2C companies to get the same alpha. And we haven't seen that yet. And it's a slower journey. And so stay tuned. I think in 10 years, again, we're going to see that coming. But the forefront is, the first B Corps are going to be Danone and Unilever. They're not going to be DuPont and Ford, right? And that's what it is.
All right. Thanks, Chris. Well, as we close, let's give each of our panelists a chance to share any closing thoughts. Mm-hmm. And you may want to also any pointers to resources or materials you think the audience might be interested in referring to. So we'll go in reverse order from how we started. We'll go with Donna, then Chris, and we'll close with Emily as we started.
Well, again, I want to thank you all for coming. And I want to say that I think we're at an incredibly exciting time. I'm very optimistic, tornadoes or not. I think that things do feel different this time. And I think what makes it feel different, and I've been around a little bit, is, people matter, and I think that we've been in such a situation, whether it's driven by technology or driven by returns or whatever it's driven by, that people and the importance of people in your organization has been given short shrift, in everything. Just think about it. I mean, it drives me nuts when I call up and I can't get a real person on the phone now at any of these places. I remember I was pickpocketed in the subway, and I called to stop my credit cards, and they kept asking for my credit card number, and I'm like, you don't understand. I mean, I can't give it to you. It's been stolen. So just the simple things about having that human touch, I think people crave, and I think that the corner may have turned on that. And so I think to the extent that we treat our employees better and our people better, which sort of comes into the ESG thing, I think the whole thing comes around. And I think the time is ripe for that, because I think people are so looking for that. We've just sort of swung so far into the opposite direction. And so I think we'll see that. more, and I think we'll see more returns generated from just doing that, you know. And we can call it ESG, we can call it whatever we want, but at the end of the day, those will be the companies that perform well, or those that treat their people well. So stay tuned, but I think we're in for a great ride.
Thank you. Chris?
I had the least time to prepare. I mean, I'll start with this turning point in comment is, for me, the main driver is information. And information is now ubiquitous, and there's no going back. And capitalism will be changed because of that. And so supply chains are now transparent, more transparent, maybe not fully transparent. Customer and service, and you can't get away with doing the wrong thing in a company, or it's much harder. There's the front page of the New York Times test, and there's the Yelp review test. Prices are transparent. So we're in a whole new era where the rules of 15 years ago don't apply today. And that is going to have a big influence on how business is done, and hopefully towards better business. And so the so-called impact investing, and I'm calling it so-called because we hear so much jargon, ESG impact, and these are two of many other acronyms and expressions we hear. It's just a question of how can we be better capitalists. That's, by the way, reliant on you in this room to think about it that way. We're 0.005% of the industry, and impact investing as a whole is clearly less than 1% still. So there's a lot of work to do. But again, the tide is shifting, and this is when I think about anybody who wants to have a career in investing or in adjacent services to investing, it's a no-brainer. Do you want to be in the kind of fast-growing side of the industry, or do you want to be in the kind of mature, kind of slowly declining industry? I'll leave that with you.
All right, then we'll end where we began with Emily, please, as the asset owner perspective.
Sure, and I share my panelists' point of view that incredibly optimistic about the future and incredibly optimistic about where you all will take the private equity industry. I really do believe that the next generation is going to do better than we've done. We want to do better. We know you want to do even better, so that's really good. ESG is critical. It's critical to returns. It's critical to value creation. It's critical to saving our planet. It's also going to be critical to the PE industry and the viability of the PE industry long term. And so maybe this is the topic for your next panel, but I spent all of last week and most of today in preparation for a House Financial Services Committee hearing on I don't know if anybody saw it, but it was a pretty damning display against private equity and what private equity has to offer society. And the only way that private equity is going to be able to defend itself is to walk the walk. Mm-hmm. And I truly believe, and I truly believe that private equity is good. We are better off with private equity. Private equity creates jobs, it creates opportunity, it creates value. But we have to do better. We have to behave better. We have to, govern better. We have to think about our employees and our people. And within the next year, private equity is going to be right in the middle of the spotlight. And ESG is one way we can point to how we're doing and what we're trying to do and be able to make the case that we really are a valuable contributor to the U.S. economy. So stay tuned. It's going to be an interesting
Wonderful.
year.